Hi, Chris Tiller with Russ Lyon Sotheby's with another quick market update. Today we are in April of 2021, so I wanted to give you a quick current market real estate update for the Arizona market, maybe specifically more Southeast Chandler, Southeast Valley and Chandler, Gilbert, Mesa, Tempe, Queen Creek. So much of the same. So currently above asking contracts is the theme. So if you've been following the real estate market at all or any of my videos, this has only gotten worse. So right now, every house that goes on the market, the average contract price, closing price, is 100% of the amount listed. So that right now is the average, which means that some are more and half are less, essentially. So in the Southeast Valley, we're seeing quite a bit more than that. But again, as an average from Maricopa County's perspective, that is one of the first times we've ever broken the 100% mark. Why I think it's relevant today to mention was that because if you go to list your house today, I'm assuming you've heard the theme that people are getting obnoxious amounts of money for their homes. This has impacted what people start their list price at. So theoretically, if you were to take a listing, or if I was to take a listing, why not try a high number? What's the worst case that's going to happen? You get something at list price or a little bit low, which is still more than what you probably had anticipated. Why that's relevant is even though people are doing that, they're still getting above what they're asking for. So it's gotten pretty extreme with the annual appreciation numbers if you march it out by the month to month. So in a previous high, so right after we had our crash and we were starting to make these large jumps after we'd hit the bottom, the average above asking was around $6,000. So that was about average in the previous boom coming up in the market, is what you could expect, again, in Maricopa County, and every area is a little bit different. This has substantially grown over time. So in the last 18 months, this has slowly ticked up. As of today, the average above asking closed transaction is at $15,000, which is pretty substantial when you talk about our average purchase price right now is about $386,000, something like that, $386,000 last time I looked at it. So these numbers, while they don't seem as a totality different, it is double what we had expected previously. So it's a big, big jump that we're tracking. What that does for appreciation, right now we're seeing about 2% a month in appreciation, a month. So if any of you math guys did that calculation, they were averaging right now at about a 24% annual appreciation rate, which we've never seen, nor do we expect to continue throughout the entire year. Last year, we were about 13 to 15%, but that is what we're seeing now, which is certainly possible when you're talking about $15,000 above asking. So that's a big one. Interest rates. Right now, we're averaging right around 3%. Still, we haven't had a huge change. We did have a jump about a couple of weeks ago. We did drop back down about a week ago. So this is staying consistent. We had a note from the Fed chair that they are planning on keeping these down in this range and have no interest in raising it above the current zero mark through the remainder of the year. So we can kind of predict that the outcome of that is going to be similar throughout, again, the end of the year. The CFPB, so the Consumer Financial Protection Bureau, has come out and said that they would like and are pushing for a complete stop in all foreclosures through the rest of the year. So people that are currently delinquent or behind on their payments, which has been kind of postponed, and there's some certain things with the CARES Act, I'm going to make another video about that, that have allowed people to stay in their homes and delay the payment. So if they are unable to continue once that CARES Act forbearance has expired, they're going to enter into the foreclosure process. So the CFPB is suggesting on a national level that we put a moratorium on that through the end of the year. If we were to not do that, you may potentially see some inventory increases over time as people decide to list and sell their homes. I don't think foreclosures moving forward are going to be an issue. One, the reason they were in the past is because the short sale process was not something most of these mortgage companies knew how to process. So it was a completely new thing for them. So to start entirely new departments within their company was an issue. So the CFPB is essentially saying that they want to postpone all forbearances and foreclosures through the end of the year. So that would delay any new inventory from that perspective. Construction materials. So the other way for us to create inventory is to just that, build it. So if you can build inventory and create opportunities for people to purchase and move into, that again is another increase in inventory, which hopefully offsets demand and starts to level off these prices and above asking offers. However, construction materials have no end in sight as far as decreases in coming in any lower. If anything, they're only going up, and it would take a significant decrease to get back down to a normal range. This is offset and caused new home construction to skyrocket, which makes it more difficult. With that being said, you are still seeing, especially in the Southeast Valley, lottery systems where you have 40, 50, 60 applications for 5 lots a month on some of these builders. The other ones are doing first come, first serve, where you put your name on a list. You might be number 70, and they just start from the top and work their way down until they get to you. You will be at the mercy of price increases over that time frame. So it's not like you're locking in your price as you're on that list. As these construction materials go up, or the builders have determined that because of demand they can raise their prices, you will be at the risk of that. So that's kind of our current market. Again, it's much of the same. We do have some new records from a listing contract success ratio, closing percentage. We've reached a new peak in above asking. We've also reached a fairly close to a new peak in a monthly appreciation rate. And then we have some really good information regarding, is this going to continue in the time? So interest rates would have an impact, any foreclosures hitting the market, and construction materials. So we don't anticipate anything over the next 6 to 9 months to offset any of this in any fashion that's going to make somebody jump off the fence or not. Now, I get this all the time. Are we going to see a crash? So I obviously do not think that. There aren't really many indication that that's a possibility, especially in the short term and in next year. But we do have some cracks. So when I talk about cracks, I do some constant research just to try to come up with, where might this come from in the real estate market specifically that would help offset some of this ridiculous growth. Obviously, I don't predict, a 9/11, an interest rate boom, crazy hyperinflation that I can't predict, because my world is real estate. So that's what I'm trying to focus on. So some of the cracks we're seeing is the delinquency. So we do have about 6 months worth of inventory in delinquency. So they have entered the forbearance market with their mortgage lender and said, I cannot afford to pay my payment. I need to go into forbearance, and they're not making their payment. Again, 6 months of inventory is what we would consider shadow inventory that could potentially hit the market. I'll make another one about why this is kind of a nonsense number. The qualification for this, I've gone through it myself, is about nothing. It's not like I have to prove that I'm unemployed or had some decrease in my income. It's a 5-question drop-down box within my mortgage portal on the website. It doesn't matter if it's owner-occupied or rental, but I could fill this out, hit enter, fib it a little bit because the questions are ambiguous, and then get delinquency, and again, not have to pay a mortgage for anywhere from 3 months to a year. So the other crack that we're starting to see or think that could be a crack is your second home and investor purchases. So why that would be considered somewhat of a concern over time is most of those people are not overly committed to their property. So they're going to be some of the first ones, if there is some type of a fear or a pullback, they would be very quick, or much quicker than somebody who required the house because that's where they live with their kids, to just liquidate, move on, and sell it. They could do it much faster without much loss, for instance, from a perspective of housing. So these are just a second home. Obviously, if things got really tough, that would be an asset that you could justifiably liquidate without feeling too bad about or feeling the pain. Same thing with investors. It's hard to get some of the information on these ones specifically. So second home, it's hard because if somebody coming from California is buying a second home in Arizona, the goal may be to use that as their primary residence, but they're buying it as a second home just so they don't have to be homeless, sell their house in California with nowhere to live in Arizona. So they could be closing as a second home with the full expectation to move into it immediately and then list their home in California. So there's a bunch of nuances. Investors, are they buying it with cash? Are they Wall Street? Are they first-time investors? Where is the cash coming from? What's the strength of the buyer? So some of those intricacies of them specifically is difficult to differentiate, but they could be a crack if you wanted to look at it that way. I just like to highlight what we can. And then mindset. This is my biggest one, I think, because it impacts everyone. So if we were to see some form of a pullback, if you remember in 2008, there was a lot of media hype and push from the mortgage companies about your moral obligation to pay your mortgage. You signed a piece of paper, you owe the money, you should absolutely pay for it. And so people, even your neighbors, would make you feel bad. There was sort of a stigma attached with foreclosures and short sales. That has absolutely changed. I mean, I don't talk to very many people that have this mindset that somehow they signed a piece of paper so they really feel like they should owe money to a bank. it's just it's a different shift in mindset. So if we did get a pullback, I think this is one of the big ones where you would see owner-occupied residents not feel as bad about going the foreclosure route or going the short sale route, and especially doing it much sooner. And so if that's the case, over the trickle time that you saw in the crash, where you saw a ride down of 2 to 3 years because people slowly got over the stigma and the bad feeling, or they stuck it out longer than maybe they should have, they ran through all of their savings, that mindset has changed. I think you could, if we saw the pullback, people very quickly pull the ripcord, get out of the house, and not feel remotely bad about it. I don't think that's going to happen, but essentially, again, I'd like to point it out. So this is kind of what we're dealing with right now with the current market update. If you have any questions, please reach out to me. Again, Chris Tiller with Sotheby's, and we'll see you on the next one.